over the last few weeks, we have a very mixed performance from the S&P 500. We have stocks that have performed very strongly, up double digits. Likewise, though, we have stocks that have performed very, very poor. That hasn't stopped insiders from buying massive amounts of shares within their own company. And in today's episode, we are focusing on 5 of these where insiders have bought massive amounts. And as always, we're going to run through each one of these. We're going to look at their historical performance to see how they performed over the last few years. We're also going to run through each one of these, look at some of their underlying supporting metrics, the free cash flow, the sales growth, ROIC, their debt levels, and much more. And with each one of these, we will run them in the valuation model. We're going to give our own perspective on the intrinsic value, what we deem to be the acceptable buy price while incorporating a margin of safety. And as always, we're going to see what do Wall Street believe the price target should be over the next 12 months. So the first one we're talking about, it is Salesforce. As we can see here, the director on the 3rd of June bought 428,000 shares. We can see for an incredible amount, just under $100 million. So we can see this is a very bullish signal. As we always say, management do buy if they believe the share price will go up over the longer term. So in terms of Salesforce, well, if you have watched our video, this did crash quite heavily in the not too distant past. In terms of buy ratings, well, a double buy, Seeking Alpha and Wall Street, we do get a hold from Quant, and as we can see, it is trading towards its 52-week lows. In terms of a yield, well, on a trailing 12-month basis, 0.17%. Forward PE, 23.44, not too far off the S&P. That does trade around 22.5, but as always, we will compare it to the sector PE. Over the last year, even after the drop, it is up around 11%. As we can see, though, just year to date, it is down 12%. And for those who have been long-term shareholders, you would be up around 303%. Now, this is a company that just recently started paying a dividend, so we don't quite have the dividend safety score yet. Market cap, 225 billion. It is a mega cap company. Now, what we will point out, even though they have just started to pay a dividend, that over the next 12 months, the free cash flow payout is estimated to be around 13%, meaning we believe here that the dividend should increase at least double digits over the next few years, while they do have that very low free cash flow payout. In terms of free cash flow per share, as always, we want to see consistent increases to this year on year, and what better diagram than this from Salesforce: 1.22 in 2015, 9.75 in 2024, anticipated to go even higher in FY25 as well, so a very strong signal for future growth. In terms of sales growth, well, they have historically had double-digit growth year on year. The more recent year of 11% is showing a downward trend from the highs of around 29% in 2020. It is up to you to decide whether or not you believe they will be able to continue with that strong growth into the future, but as always, we can incorporate this into our own margin of safety. Numericals then, well, we can see some very strong growth on their top line. In fact, around 7 times growth just over the last 10 years. What we can see, however, with this company, whilst we love it when companies do those share buybacks, returning excess cash, over the longer term, Salesforce would have diluted your position as a shareholder. Now, ROIC, for me, one of the most important metrics. We want to see 10% or more just to give us faith management are able to effectively allocate their capital. 8% in 2024, the highest we have seen over the last 10 years. Nice to know on a trailing 12-month basis, it is higher at 9%. Hopefully, over the longer term, this can start to increase into the double digits we love to see. Operating margin, well, typically 16% or more, so they have gone through many years over the last 10 years where it has been very, very poor. Nice to note, in the latest full year, 17%, trailing 12-month, 18%. So again, hopefully we can see this increase into the future. No worries though to note here with the free cash flow margin, very strong consistently, and in fact increasing over the last 10 years, 32% on a trailing 12-month basis. Very, very attractive for those shareholders who are considering purchasing. Net debt to EBITDA, so that is the earnings before the interest, tax, depreciation, amortization. One of the reasons we do focus on this metric within our analysis, it does correlate to both dividend safety as well as balance sheet strength. Now, these numbers that you see for every single year, number of years it would take the company to pay off all of that debt net of cash on hand. 2024 for Salesforce, it wouldn't even take them one day. Over the next 12 months, again, the same is to be said. So an incredibly safe dividend that we do believe they will increase double digits over the longer term. And secondly, their balance sheet does look very, very strong. So in terms of the valuation model, let's get into it. And as always, if you do enjoy the content, value is being provided. Smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now for Salesforce, we just use the DCF model. We do believe it to be the only relevant one. Now what we will do, just to let you know how we arrived at this number, well, we have the DCF model with the free cash flow year on year, average growth rate. Now forward looking, we have got three rates here, a low, medium and high, and as you can see, the different growth rates do give a different value with the implied upside attributed to each one. And we can see though, for a 10%, which is what we do believe, we want to go for a conservative but not do conservative, so we go for the middle percent. At 10%, that does give us the intrinsic value of $321. Now margin of safety at 10%, as always, we do execute on this if we believe it meets our three golden criteria. Wide moat, strong financial metrics, good forward-looking data. It does indicate a buy up to $289, but we keep going till it's near the current trading price. And what we can see in today's episode for Salesforce, not at a 30% MOS level, but at least at 25% up to around $241. In terms of Wall Street and their forecast, well, over the next 12 months, they see upside of 31%, their price target $304, indicating this to be a massively strong buy and definitely one to consider for the portfolio. This then brings us on to the next stock with massive insider selling, Norfolk Southern Corp. In fact, we note three instances from three different directors, 29th of May, 30th of May, as well as another purchase on the 30th of May. And we can see here, all directors have been buying shares. We have around $500,000 from director KTC. We also have essentially $750,000 from Hufford John C. and then Claude M with $1.2 million. So again, another very bullish signal for Norfolk Southern. And when we do take a look at this, we have a double buy rating, a hold from Quant. It is trading in the mid to lower end of the 52-week range. Forward yield 2.46% and a forward P sitting at 18.59. Although we do note over the last 12 months, it does look to be pretty flat. Over the last 10 years, though, it is up around 110%. We can see all-time highs sitting around just under $300 around 2 years ago. So in terms of their dividend safety score, well, 86, so very safe. Market cap just under 50 billion, a large cap company. And it was reaffirmed last month that the dividend safety score means a dividend cut does look to be highly unlikely. Now, key recessionary metric from the last recession, they increased the dividend during the 07-09 Great Recession. Below average growth, negative 25% when the S&P itself was negative 12, although they did marginally outperform negative 48 with the S&P negative 55. Now, we are still waiting on a dividend increase for the latest year, but over the last 5 years and over the last 20 years, we can see double-digit growth to that dividend. And we do note 7 years of consecutive increases with 22 years of paying a dividend without a reduction. Now, what we always like to do on this channel, dividend yield theory. So for those that are new, it does state a company is undervalued when the current yield sits above the 5-year average. So we have one signal of undervaluation, another marginal undervaluation signal, 17.7 below the 5-year average of 18.5. And we also note a triple undervaluation. It is lower than the sector P of 19. Just bear in mind, though, that essentially we don't look at any of these models in singularity. We will conclude towards the end. As always, free cash flow payout over the earnings, which is susceptible to manipulation by management through accounting. Below 60%, they have hit that pretty much every single year, bar 2023, and that is one of the reasons why we do look at the free cash flow. The earnings, you would see 46%, you would be happy, you would be on your way. 2023, though, this signals that management paid out more in dividends than they generated in free cash flow. Now, that is a red flag indicator to us, but what is nice to note, it is anticipated over the next 12 months to come down to 69%. In terms of free cash flow, well, it has been increasing over the longer term, but a lot of inconsistency. In fact, from the highs of 2021, it has started to come down, and we do note that over the next 12 months, it is estimated to go back higher, nearly double, so a positive sign they are turning this around from the lows we have seen in the more recent year. Sales growth, well, one thing just to anticipate with NSC that it is in a cyclical industry, hence why we do see 5 of the last 10 years negative growth. Very strong growth, in fact, in 21-22, but in fact, the more recent year, negative 5%. And when we do look at it in terms of over the last 10 years, you could argue a lot of cyclicality due to the highs and lows, but also if you incorporate inflation, that in terms of real terms, over the last 10 years, there has been very minimal growth. What is nice though with this company is they have done a lot of share buybacks and it is very consistent. So you do know what you're getting. Pretty much every single year they are doing share buybacks. So that is very nice on top of that double-digit increase they have had over the last 5 years. ROIC as well, it is around that 10% or higher target that we like to see, 11% in the more recent year. So that is another positive to consider. And the operating margin side, even though it is very inconsistent year on year, it is well above the minimum we want to see. So that is great to note from a margin perspective. And more specifically on the free cash flow margin, again, whilst it is inconsistent, above that minimum 5% that we do target here on this channel. Net debt to EBITDA then, below 3 is the preference, and it has been below 3. Granted, it did increase from 22 to 23. It is anticipated to reduce marginally into 2024, but just something I would advise to keep an eye on if you are a shareholder or looking to invest in this company, especially with the high free cash flow payout we did see in 2023. In terms of the valuation, as always, you can grab a copy of this model by clicking on the pinned comment below to get to both intrinsic value as well as acceptable buy price of companies in your own portfolio and those on your watch list. So margin of safety then, we do start off with 10%, and what we can see, a buy up to 229 at $15. It isn't quite there yet, around $4 shy. So for today's episode of this insider buying company, we see 10 to 15% at the MOS level. In terms of Wall Street and their expectation, well, they believe the share price will go much higher, in fact, than our intrinsic value. They see upside of 24%. And again, similar to insiders who have been buying, Wall Street do consider this a buy now stock. Before we do move on to the next stock, just to let you know, we have released our latest free weekly article. If you want access to this or any other articles, all completely free, instant access, do click on the pinned comment below. For example, if you want to find out undervalued stocks and how we look at them, the screeners, the websites, that is all in this article, or one of our most recent articles on 12 high quality undervalued dividend stocks, you can sign up and read straight away. We then take a look at the next insider buying. We have Agree Realty from the director on the 23rd of May, 20,000 shares, around $1.2 million for this real estate investment trust. And when we do take a look at it, we have a triple buy rating from all three analysts, trading pretty much bang in the middle of the 52-week range with a forward yield just under 5% and a P to FFO of around 15.05. Now, over the last 12 months, similar to the industry as a whole, it hasn't performed that great, down 7%. Over the last 10 years, though, we do know you would be up around 100%, but it has hit its all-time highs of around $80 a few times, as we can see the more recent one around 2 years ago today. In terms of the dividend safety score, well, a 70 score indicating safety, market cap just over $6 billion, so this is in fact a mid-cap company, and it was reaffirmed last month. Dividend cut does look to be unlikely. In terms of the Great Recession, well, they cut the dividend, they had average growth, but they did trail the S&P like the majority of REITs, negative 67%, and we do know a fairly poor 1.2% increase to their dividend in April 24, and again, the reason why we indicate that this is a poor increase, it is below the inflationary target of 4%. Over the last 5 years, though, it has on average increased by 6%. Over the last 20, though, around 2% year on year, and they have increased those dividends for the last 11 years consecutively. In terms of dividend yield theory, well, we do have a severe undervaluation signal on the yield, but also on the forward P to AFFO of 14.8. What we can see, though, that the real estate sector itself is marginally lower at 14. Now, in terms of free cash flow payout, do remember for REITs, we don't tend to look at this. It is a lot more volatile, so we draw your attention to the adjusted FFO, funds from operation, and we want to see below 90% for REITs. In fact, not only below 90%, but it has been decreasing, estimated 72% over the next 12 months. In terms of adjusted FFO per share, well, similar to the free cash flow per share we typically look at, we want to see consistent increases year on year. That is exactly what we have with Agree Realty. And again, over the next 12 months, this is expected to continue. Now, in terms of sales growth for REITs, double digits or 5 to 10% at a bare minimum. We do note double digit growth, so that is always great to see. Higher than the minimum we target. 25% in 2023, also looking very healthy. We have the total sales, which has been phenomenally increasing year on year, which is a great sign. But what we also want to point out here is that with shares outstandings, very typical with REITs, they will dilute your position as a shareholder. Again, the reason for this, they don't retain a lot of that internally generated cash flow, and therefore they do have to dilute your position. But what we would say is some REITs dilute your position at a different rate. However, ADC do dilute your position at a very rapid rate compared to others. ROIC then 3 to 5% is what we target for REITs, so lower than the 10% plus for other companies. It has been decreasing, so not a great sign, although it is at the minimum over the last few years. Nice to note 4%, so a little bit of an increase on the trailing 12 months. Now, operating margin, not the greatest due to the fact that it is operational inefficiency as it is decreasing, but still in the high 40s is a very healthy number. And one of the most important metrics we want to see is that net debt to EBITDA to ensure their balance sheet is strong and they can continue to pay a very nice forward yield with some nice increases into the future. Now, for REITs below 5.5, we do know that it has been straddling around that. The one positive to take here is it anticipated to drop to around 4.86 over the next 12 months. Now, in terms of the valuation for ADC, in today's episode, the average of these two models at just over $67. We do use that margin of safety, and we see that on a 10% MOS, it isn't that far off, just under $1. So for Realty, we would say 10% based on our estimates and judgments. And interestingly, Wall Street do agree with our intrinsic value, as this is where they see the price over the next 12 months, indicating around 9% upside during this period. As always though, do let us know your thoughts whether or not you are also adding to any of these as we go along. We then move on to Snowflake, which as we can see, the director has bought just shy of $10 million, and again the 7th of June, so not too long ago. When we take a look at this company, it is trading right there at its 52-week low, a buy rating from Wall Street, although we do note a double hold from the other two. Over the last year, we do note it is down around 30%, and when we take a look at some of these metrics, it's positive to see that the free cash flow from being negative in 2019 to 2021 has not only increased its position to 22-23, but also it is moving in an upward trend that we love to see, and over the next 12 months, this upwards movement is expected to continue. Now, in terms of sales growth, fantastic growth, in fact triple digits from 2020 to 2022. Whilst it is still strong in 2024, it has slowed down, so do bear in mind when you are looking at your estimations and projections whether or not to consider if you believe this strong growth will continue into the future. In terms of numericals though, we do see it grow very rapidly from 100 million in 2019 to 2.81 billion in the more recent period, but we also note they would have diluted your position as a shareholder quite dramatically just over the last few years. ROIC, well, this is negative. Now, what this indicates, they haven't turned a profit yet, as this number is negative every single year over the last 7 years. And what we can see on the margin side, that is also showing us the very same point, although the one positive to take, the margins are getting smaller, which is always good. Ideally, we can see them turn a profit over the next few years. However, interestingly, their free cash flow margin from 2022 has been positive, and the last 2 years are very, very strong. So hopefully if they can continue this is a great sign that it is moving in the right direction. What is also nice to note with Snowflake is over the last 3 years and expected over the next 12 months, zero on this metric, meaning not even 1 day for them to pay off all of that debt net of cash on hand. So let's jump into the valuation model for Snowflake, and as always, if you do enjoy the content, value is being provided, smash that like button, hit that subscribe and bell button so you are continually notified of this video as it drops. One thing that we do want to point out for this company, as we just base it off the DSCF model, this intrinsic value is essentially coming from a growth rate of 20%. When we've done our deep dives, we've gone through 3 different rates similar to what we analyzed on Salesforce today: 20, 25, 30, just over the last few years at around 80%. What we have done in today's episode is go for the bare minimum, as 20% you could argue is still very high moving forward. Now, if you are someone who believes it should be high, you can already see the different implied upsides, and as always, you can grab a copy of this model if you do want to run your own numbers through. So the 136.90 for today is based off a 20% growth rate moving forwards. And what we can see on a 10% margin of safety, a buy up to $148, 20% up to $131, and at 25%, not there just yet. So in today's episode for Snowflake, we do see a 20 to 25% MOS level. Now, interestingly, when we take a look at Wall Street and their forecast, They believe over the next 12 months, this price will be significantly higher at $207. Their implied upside is 63%. Therefore, they do consider this one of the strongest buys right now in the market. We then move on to VF Corp. Bracken Dow, the president and chief exec officer, on the 10th of June, so literally last week, bought over 75,000 shares for around $1 million. Again, another very bullish signal for the company. Now, with this stock, we can see it is trading right there towards its 52-week lows, although we do note a triple hold rating and a forward yield around 2.64% and a forward P of just under 20. What we also want to remind you for this company, which we will touch upon, is that they did have a recent dividend cut. Over the last year, down 29%. Over the last 10 years, down around 77%. Now, dividend safety score, even after their cut, sits at 40 unsafe. Market cap, $5.31 billion. It is a mid-cap company, and we can see just last week, it was reaffirmed that essentially their unsafe rating, suggesting a moderate to high risk of a dividend cut over a full economic cycle. Now, the last recession, they did in fact increase the dividend. They had above average growth, and they also outperformed the S&P with their negative 39% return. And as we can see, a 70% dividend cut last October, indicating over the last 5 years, the dividend has been decreasing 17% year on year, although over the last 20, it has been increasing 6%, and they therefore, no surprises, have 0 years of paying a dividend consecutive increases year on year. In terms of dividend yield theory, well, again, this is a bit irrelevant given the fact the yield was very high and then got cut, but what we can see on the forward P, it is trading pretty much around the 5-year average of 18.6, although we do note the consumer discretionary sector as a whole sits much lower at 13.9. Now, in terms of free cash flow payout, it isn't below 60% consistently. In fact, a few years where it has been significantly higher. Positive to note, 38% last full year, 25% anticipated over the next 12 months. And what we see here in terms of the free cash flow, a lot of inconsistency year on year, perhaps a downward trend as well, especially with the next 12 months anticipated to be lower than the last full year, and probably one of the worst sales growth graphs you want to see. In fact, as we can clearly see here, around 6 of the last 10 years, it has been negative growth to their top line. And in fact, in 2015, their top line was much higher than 2024, 11 billion versus 10.5. Now, we will also mention they have bought some share backs, as we can see, 432 down to 388, although this is fairly trivial for today's episode. The ROIC, actually, it was pretty strong for a long time, but it has been decreasing, 7% in 2024. So again, as you can see, a lot of poor metrics for this company, even though the insider has bought around $1 million shares. And if this is something you are considering, again, ensure you do have a nice margin of safety. Operating margin, as we can clearly see, it has been decreasing 6% in the more recent year. Free cash flow margin, very inconsistent, but more often than not, around that 5% plus level we do like to see. And probably one of the reasons why we do get that unsafe dividend score, they do have a lot of debt which has only been increasing over the longer term. 4.55 in 2024, 4.85 over the next 12 months. And now, if I was honest, this is definitely a stock that I personally would not be touching. A lot of red flag indicators across the chart. And in terms of the DCF model, well, the intrinsic value today is coming around just under $14. So in today's episode, we only believe the DCF model to be relevant, but for full transparency, you can see that we have used a 4% forward-looking growth rate, with the other growth rates low and the high. If you want to see the different upsides or implied downside / upside, you can see it here. And don't forget, if you do want to run your own numbers through for any company we review today or on your watch list portfolio, you can grab a copy by clicking below. So intrinsic value, in all honesty, isn't too far off current trading price. So we would say in today's episode, it is pretty much trading at a fair value. But for those that are looking at a 10% margin of safety, you would be looking at around $12.52. In terms of Wall Street and their estimations, well, they believe around 3% upside. So similar to our intrinsic value, they do believe it is trading near enough its fair value. As always, if you have enjoyed the content, value has been provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. And as always, let us know your thoughts in the comments, and we'll see you all on the next one.